Welcome back to Chain Finance, your home for advanced trading concepts. Today we're breaking down one of the most important behaviors in the market, a behavior that confuses retail traders every day, a behavior institutions use to activate real moves. We're talking about liquidity grabs, and why the market takes stops first before moving in the real direction. Understanding this will completely change the way you trade. Let's start with the basics. Every high and every low holds liquidity. That liquidity is made of stop losses. Buy stops above highs, sell stops below lows. This is where retail traders risk their money, and this is exactly where smart money looks first. The market doesn't move randomly, it seeks out pockets of liquidity, because liquidity is fuel, and without fuel, the market can't move strongly. That's why stop hunts happen. It's not manipulation, it's normal price behavior. The market must grab liquidity before trending. Now let's define what a liquidity grab is. A liquidity grab occurs when price spikes above a previous high, or below a previous low, takes the stops, and then immediately reverses. This move traps retail traders and activates institutional orders. It's sharp, fast, and intentional, and it reveals exactly where the real move will go next. Now let's break down a liquidity grab above a high. Price is in an uptrend. Retail traders mark the recent swing high. They put their buy stops above it, or they keep selling with stops placed above it. Smart money sees this pool of liquidity. Price spikes up, sweeps the high, clears the stops, then reverses sharply downward. That reversal is your signal. Liquidity was taken, and the real move is now happening. Now let's break down a liquidity grab below a low. Price is trending downward. Retail traders mark the previous swing low. They place sell stops below it. Others buy too early with stops below that low. Smart money sees both pools. Price spikes down, sweeps the low, triggers stops, then reverses sharply upward. The reversal confirms the grab. Liquidity was collected, and direction is shifting. Liquidity grabs happen everywhere. At highs, at lows, at equal highs, at equal lows, at trendline touches, at support and resistance zones. Anywhere retail traders cluster orders. The market hunts those orders, not to manipulate you, but because it needs liquidity to move. Liquidity grabs are also connected to structure shifts. Often after a liquidity grab, you'll see a chalk, or a boss in the opposite direction. That confirms the real move. Liquidity gives chalk, gives boss, gives trend reversal. That sequence repeats across all time frames. Now here's the key. Liquidity grabs are not signals by themselves. They must be combined with structure, and displacement, and high probability zones like FEGs and order blocks. When all of those align, the probability becomes extremely high. That's why professionals use liquidity. They know where price must go before the trend begins, and they wait for the sweep. They don't chase the move. They anticipate it, because price must clear liquidity before it can expand. Study liquidity grabs on every chart. Mark the highs and lows. Watch how price reacts when those levels break. Over time you'll see the logic. Price reaches for liquidity first, then makes its true move. This is how the market operates. Not with randomness, but with intention and precision. Understand liquidity, and you understand how smart money truly moves the market.